Good afternoon, everybody, and welcome to the first of Hardman's Tax Advantage Forum, which is about new approaches in EIS. I'm Brian Moretta. I'm Head of Tax Advantage Research at Hardman Co. I'm sure most of you know who Hardman Co are. We do high-quality reviews in the EIS space. We also do panel services and associated services for financial advisors. And for those of you like your media, we also have a podcast, which you can go and look at, but not now, not until after the webinar. We've got a very full schedule ahead. We've got 5 emerging managers, very high quality caliber of presenter here. And I'm really looking forward to seeing what they say. We're going to run through them in sort of, keep everything to try and schedule, to try and keep that, keep everybody's time conserved. So in order, we'll have James Faulkner from Vala. We'll have Dr. Ilyan Ilyev from EMV Capital. We'll have Dr. Mark Dabadi, and David Walters from River Capital. We've got Marcus Love from Love Ventures and Mark Beaumont from EOS Advisory. And what I would like to do is introduce my co-host, who is Steve Dobson, who's Head of Investments at GrowthInvest.
Hi, everyone. Thanks, Brian, for the intro, and great to be here chairing this particular webinar. So as Brian said, my name's Steve Dobson. I'm Head of Investments at GrowthInvest. For those that don't know, GrowthInvest is a platform providing administration services to wealth managers in the alternative investment space, predominantly around tax efficient and predominantly around the EIS, SEIS, which can be paper heavy, not so digital and hard to manage for advisors and their clients. And we can help solve that along with the managers and their custodians. So with that, I'm going to hand back to Brian, who's got a short intro now.
Thanks, Steve. So I'm going to do a couple of things. One is I'm going to speak very briefly about how EIS fits in a portfolio. And then I'm going to talk a little bit about the tax release, which basically to save all the other managers talking about the tax release. So I think for those, I'm sure there's some very experienced investors on here, so who will know a lot of this. But I think it's worth reiterating that when you think about how EIS fits in a portfolio, that you're really talking about venture capital investing. And venture capital companies do fundamentally different things from what smaller companies do. They're trying to find a minimum viable product. They're trying to find product market fit, or they're starting scaling. Now, as they mature, they get closer to what sort of, you feel like, normal quoted companies do. But a lot of the time, they're doing something very different. It's also tends to be uncorrelated with economic activity. Finding that first customer or first 5 customers is hard. It doesn't matter when it is. So consequently, that means that their activity has a low correlation with perhaps other investment classes. However, ultimately, what we're looking for is, although we sometimes see venture capital companies, in particularly US listing, the reality is most of them get sold. And the value you get on sale depends on the buyers. And if buyers are healthy and have lots of money, you get lots of cash. And if they're struggling a bit, you don't get quite so much cash. So the exits depend on wealth of buyers. So venture capital has some diversification benefits in the portfolio. It's not as good as, say, bonds, but it's better than, say, private equity as a whole. So correlation is about 0.5 for those of you who like these numbers things. So what that means is that you can actually bring venture capital into your portfolio. You can improve your expected return. Venture capital is a high risk, high return, or high return, hopefully high return, high risk is the way we want to think about it. So you can improve expected returns without changing over portfolio risk. You've got to shuffle the other assets around a little bit. And financial advisors, I think this is something where you can definitely add value to a portfolio by saying, okay, you can improve your expected return. You're not improving portfolio risk. What's not to like? And this is all without tax release. So no benefit of tax release. So when I've done the maths, this kind of suggests that investors should maybe do a low to mid-teens proportion based on, in an equity bond portfolio, other assets classes mix up. So that gives you some sort of indication. EIS can be a very good part of a portfolio. I'm going to speak very briefly about the tax release. Again, I'm sure a lot of people know about them, but it's worth reminding people. We have, in the UK, 4 of the 5 most generous schemes in the world. That was, at least that was the state play when Someone did a survey about 5 years ago or 6 years ago. It's a big EU survey of these things. So what are the main reliefs? Well, in EIS, you get income tax relief on investment. So that means for every pound you invest, you can offset that by 30p against your tax bill. If you're doing SEIS, and I don't think we've got any SEIS investors, but you can get 50%. So tax relief up front, that's great. You got two CGT benefits, which is obviously flavor of the month, given what happened in the budget. So the first is that any gains you make on these investments are tax-free. So there's no capital gains tax payable on investments when they're realized. Also, there are CGT reliefs on the way in. So in EIS, you have what's called deferral relief. And what that means is that you can take the whole gain on a previous capital gain, not pay your tax now, invest that in EIS, get whatever return, and then when that's realized, then you pay the capital gains tax due. So what you'd expect to do is invest in EIS, hopefully get the good return, and then the return exceeds what you're paying capital gains tax. So effectively, you're getting the offsets the capital gains tax. That's the idea. Or at the very least, you're getting and you're getting to return all the capital. You also have loss relief, which means if an investment goes wrong, you can offset the net investment, so that's the amount you invested less the initial tax relief against your income tax bill. So if you're a 45% taxpayer, that means the maximum loss you can have is 38.5p for each pound invested. 40% taxpayer is slightly more. So that's sometimes underestimated benefit. That can add a couple of percentage points to your expected IRR. And then also for you've got direct investment, you can get potential relief of up to 40p in the pound. Obviously, under the budget, that's going to be capped in the near future up to 1 million. But the EIS investments and the SEIS investments are qualifying for BR. So even once you get that, even when the new rules come in, if they come in as proposed, you'll still get 20% on anything above 1 million. So those are the main tax benefits. Hopefully they're all familiar. If anyone's got any questions about them, they can ask us later. But I am going to stop there. And what I will do is I will move on to our first speaker. So I'm going to start with James Faulkner from Vala. I've known James for some time, and I have enjoyed many conversations with him. So I'm really looking forward to hearing him this time.
Great, thank you, and thank you so much for this opportunity. It's great to be involved with such an esteemed panel of speakers, and I'm looking forward to just spending a few minutes sharing with you a bit more about what we do. Let me share the screen. Hopefully that looks about right. And you can see the screen in front of you. So we're up to our 14th tranche, although we've only been around a few years. We're up to our 14th tranche, and but I still get really excited about making investments and getting investments completed for the investors, as well as seeing the progress within the portfolio. The ups and downs of venture investing are part and parcel of the venture sector. The disappointing stories, as well as the really exciting stories, are part of the game. But we're rewarded because we get involved in some great businesses with some great teams. We see the impact of those businesses within their sectors, the disruption they cause, and then we get rewarded with valuations heading in the right direction, which is great. I want to focus a little bit on these guys because although Arthur retired in the investment committee, it's the collective and collaborative experience of these guys that were really the inspiration and the basis for the strategy that we have at Vala. My job is to run the business, but it's these guys who have been making the decisions alongside as part of the investment committee into into which businesses we invest. But they themselves have got decades of experience of investing into these kinds of businesses, both conceptualizing them, building them, raising money for them, all the challenges and some of the failures that go with that, but also the tremendous successes that come with it. And you can see the reviews around their track record. But just to give you a bit of a picture, and I'll emphasize this is the track record of their track record as they come to build and make decisions on the Vala portfolio alongside Sapphire, the principal for the investment manager for the fund. And so this is their track record. And we identified there were 77 companies of a commensurate size with these investments. EIS type investments. They put 33 million of their own money. This is over several decades. 38 million was raised from co-investor. And of those 77, there's been 39 exits for good and for bad. But in aggregate, across all of those 39, of the 55 million that was put into those businesses, 167 million was returned to investors. And that's the kind of track record that Vala is based on. So not just one-off successes or even two-off successes, but many successes that lead to that kind of track record over about a 4.5 year period. So that's the basis of the team that we're seeing. Who is Vala? We did our first investments in March 2018. So we've invested in over 35 companies to date. We adopted what we now call a sustainability strategy. When we were first doing what we do, we didn't used to use that term, but we do now, and I'll come back to that in a moment. But it's about, as well as doing the right thing, it's also because we believe that sustainability is the right commercial approach for these businesses. And you might have noticed that Vala has adopted one of the FCA's new SDR labels, sustainability improvers. There's three things I'd like to get across in our couple of minutes together. First of all, that venture building sits at the heart of our strategy, and we'll talk a bit about that in the limited time we've got. That sustainability, a focus on sustainability, has been always important to us and remains a central plank of what we do. And then thirdly, just to get a bit about the mechanics of our portfolio and the key things that you would need to know in terms of recommending it to your clients. Sustainability, I've mentioned a couple of times. And of course, it is about doing the right thing, and there's nothing wrong with that at all. What we want our businesses to be doing is becoming more sustainable. And that's why it's called better, because we want them to become better. And that's important for the way that we live and work and operate in our lives. But we also think there's a commercial imperative. And we've made the capital through the Better Ventures contingent on those companies meaningfully and tangibly committing to becoming more sustainable. And we do that principally using a platform called Future Plus, and then we'll report on that basis. But we don't think it's, as I say, just about doing the right thing. We think there's a commercial imperative. We think by having a focus on sustainability, the outcomes will be stronger to the investors. And there's been some great examples over recent years when we saw the energy crisis and spike in energy prices. Companies that have spent time considering energy usage and how they use energy, but how they source their energy, will be in a better position to weather those kind of storms. We saw that a couple of years after COVID, when there was a supply chain crunch. Similarly, companies that have spent time considering their supply chain, thinking about circularity, thinking about wastage, will be better positioned to accommodate those storms when they come. We think there's lots to unpack in this, but the adherence of employees into those businesses will be greater because they're not only bought into the commercial opportunity, but also the values of the business. And we think finally that exit values will also support this. Now, there's evidence that needs to come through for that, but we think acquirers and potential acquirers, Brian mentioned about acquisitions, potential acquirers will want to see that business have focused on this and can evidence it as well. So that's why sustainability is a key part of our investment thesis. So this is the Better Ventures EIS. There's the sustainability improvers label that we've added as well as part of the FCA's SDR regime. So you and your clients can have some assurance that we are committed to the process and will be reporting on that basis. And the mechanics are a minimum of 6 companies in each client's portfolio, no more than 20% committed to each individual company. And you can see the minimum there, 20,000. We'll come back to stage of investment at the moment. But the key date for this year is the 28th of March. So if you and your clients would like to be fully invested before the tax year end, then we need applications and subscriptions by the 28th of March. This slide is a little bit about diversification, which Brian's already mentioned. The idea that there's diversification in terms of the age of the businesses, that we invest both relatively early stage, but also across a number of sectors and themes. And there's sectors and themes that we're familiar with and that we can add some value into. And there's also some cross pollination of ideas and some alignment between those businesses. As well. You can see there that things are broadly or generally going pretty well. All of our, or to see that investors' portfolios are heading in the right direction, and that's the cumulative approach on measuring that success. But each individual's client's portfolio is going to look slightly different. But broadly speaking, it's great to see things heading in the right direction. Venture building, I've mentioned. The idea that we work with businesses from the very beginning. It's not exclusively the case, but it is predominantly the case within our portfolios that we'll work with founders who've got a great idea, we'll support them with early stage capital, and then the funds can get involved as those businesses mature. And here's 4 examples of businesses that have been venture built. And I'd love the opportunity to talk to you more about those 4 and many others in the portfolio of how we supported the founders from early stage. We supported them in terms of physical space, in terms of personnel, finance, accounting, all of those things that are useful, but really to support them in building their businesses. And we make a commitment that if things are heading in the right direction, we will continue to support them in their funding. And so there are particular examples of companies heading in the right direction. Fees are important to you, important to your client. We believe that this is a fair balance. We take an initial fee on behalf of the investors, or the fund takes an initial fee on behalf of the investors through the portfolio companies. Your clients will have 96.4% of their initial investment after any advisor fees invested into the portfolio companies, because we hold back the first 2 years worth of AMC prior to deployment. We think that's a fair balance. We only will take AMCs for the first 5 years. After that, there won't be an AMC taken. The idea really is that those companies should be exiting. So again, we think that's fair. And we take a performance fee at portfolio level. So only when we've got 10% growth back for the investor are we going to start taking some profit share as well. So I think that's broadly about it for me. Those are the things, the mechanics that you're there. So the 3 things were about our commitment to sustainability and why we think it's important. Secondly, the importance of venture building, of being with founders from the very beginning, and then the mechanics of the investment portfolio. So I hope that makes sense.
That's great. Thank you for that, James. You mentioned a lot about the sustainability and the fact that you guys have adopted one of the FCA SDR labels, which came into play as of late last year. Why did you think that was so important for you to do that? Because looking across the kind of the spectrum of funds out there, a lot of funds talked around ESG over the last X years, but not many have adopted labels, and we've almost gone from this kind of perceived greenwashing to a green hushing phase. So keen to know your thoughts on that.
Yeah, well, thank you. Yeah, I mean, we as a group that were committed to sustainability, we always found it somewhat egregious when others were talking about ESG without any discernible way of understanding how that applied or whether it was just greenwashing. So the SDR thing was not a difficult decision for us because it's things that we were doing anyway. We use I mentioned Future Plus. About 80% of our portfolio use Future Plus. So we've been able to report to our clients on the progress, both at a fund level and individual company level, towards becoming more sustainable with our companies for the last couple of years. So it was a relatively easy decision. And because we do talk about sustainability, there is an obligation on us to either adopt it or change our language. So we welcome it from the FCA because I think it will remind people about greenwashing. But as I say, for us, it's about doing the right thing. That's why it's really important. But we think there's a commercial imperative, and we hope to see. We already think we're seeing it in our portfolio already, but the evidence will be there that it's a commercial benefit by focusing on these things. So yeah, that was about it.
One question in: who values the valuations of the portfolio holdings, and how do you do
Yeah,
that?
I'm sure this will be a common question for all of the team, and we are obliged to follow BVCA guidelines on valuation. So try and assess a fair value. We revalue formally every 6 months within our portfolio. The easiest way to do it is if the company has had a recent funding round, particularly where there's third parties involved. Ultimately, the value of the business is what somebody's willing to invest in at. So having had a recent funding round is the easiest way to assess the value of a company. In the absence of that, then we have to take a view on the progress of the business, in particular its journey towards revenues, maybe less so profitability in the early stage investing, but how are they doing towards their target. So generally speaking, it's an internal process for valuations. We like to see third-party validation through investment. Then that's nice and easy and nice and clear, but we'll go through a third party. If there is sufficient data, then adding models, discounted cash flow models, that kind of thing is an additional tool for that. But that's how generally we do it.
Great. Another question in. I'll keep this anonymous. The recent vintages have not performed well. Is that to be expected, or is it exceptional?
Well, thank you for spotting that. Well spotted, whoever that was. That's well done. Yeah, I think so. I mean, nobody, everybody wants to see portfolios in the green rather than in the red. But yeah, a couple of companies early in their life have fallen over. It always hurts a lot. We seem to spend an awful lot of time and energy on those companies, and some survive and some make it through and some don't. So yeah, it's a bit of a cliche of the lemons ripening before the melons, but it does seem to have been the case over the last couple of years. I think challenging economic decisions have been part of that, but not exclusively. So we have seen some companies some companies in the portfolios fall over. We are pretty confident that there's some really exciting ones in there that will build towards success. So we've got really patient investors, but we're hopefully seeing them heading in the right direction. Perhaps Brian's got something to add on that. I don't know.
I probably do have something to add on that very briefly. I think I'll second James's comment that in venture capital, what you generally see the failures before the successes, and that's just the sad truth. And that's actually to be welcomed, because the last thing you want is managers pumping money after companies that are failing just to pretend they haven't failed. I think the other thing I might add is that venture capital valuations peaked in 2022. We've had a couple of years of a down cycle. There's a lot of debate about whether we're at, near, or past the bottom. But I think I think general consensus we're probably past the worst on that. So we would hope for a general market improvement from here. I think we've had a very, very tough couple of years in the venture market. But I'd like to thank James. We're going to move swiftly onward so we don't go behind schedule. So our second guest is Dr. Ilyan Ilyev from EMV Capital. Ilyan's also someone we've known for some time. He was actually the very first person I interviewed for the podcast, which he reminded me of recently. But again, I'm looking forward to seeing what he says. So, Ilyan, floor's yours.
Brian, thank you very much. And just give me a second until I sort out my IT. But no, I want to thank Hardman for all the good work you've been doing in the EIS industry and beyond. So it's been a pleasure working with you guys. Okay, well, thank you very much for the opportunity. So I'm Ilyan Iliev, the CEO of EMV Capital PLC. We are a deep tech and life sciences venture capital investor. I won't bore you through the very important disclaimer, but I want to flag this is not a financial promotion. It's broadly about our practice. And of course, if you want to find out more about the EIS fund, there's some contacts at the end of this presentation. So we follow a slightly different approach. We're actually an AIM-listed company, and EMV Capital today is the result of the combination of EMV Capital, which I founded, Net Scientific PLC, which was a name-listed company. The two companies combined in 2020. And most recently, last year, we also took over the fund management of Martlet Capital in Cambridge. So we target, invest, and build high-growth companies. We have both UK and non-UK investees, but increasingly our focus is UK companies seeking to expand internationally. We have roughly 100 million of assets under management as of the middle of last year. Because we're a PLC, we have the kind of the PLC reporting format. So the next annual report will show where we are now. I think somewhat uniquely in our space, a fairly large proportion of our AUM is directly owned. So roughly 41 million is direct balance sheet holdings. And I think this reflects that us as if you think of us as a GP, we have a really significant stake in the various companies we work with. And next to that, there's roughly 65 million of third-party money that is managed. We are directly FCA authorized, but I know there's some colleagues here from Sapphire. They helped us over many years as we were growing up and learning the ins and outs. So it's really important to have people such as Sapphire as part of the ecosystem. However, now we are directly authorized with both corporate finance and fund management authorizations. We have 70 portfolio companies. As I get into it, you'll see that we run different strategies. In some cases, we also have some slightly different take on a venture build program, but there are some companies where we've taken a deep stake, and yet others where we have smaller stakes. And on the fund management side, there is the Martlet Capital operation in Cambridge, and there's the EMV Capital Evergreen Fund. We're ambitious and on a growth track. Our next milestone is 200 million AUM. We think that's quite possible within the current opportunity set. We have a team of roughly 15 people. Here you can see the key board members and some of my colleagues on the fundraising side. My own background is I'm an economist, but I've been in venture capital or deep tech for most of my professional life. I'm also a significant shareholder of EMV Capital. My colleague Ed Hooper, who is a career corporate lawyer with immense experience in M&A, IPOs, and venture. Dr. Charles Spicer, who is a specialist in the life sciences space. He used to lead Nomura's life sciences side. Dr. Jonathan Robinson, who is our SID, but also quite active on the Cambridge side in particular, who has founded and listed his own company. And a wonderful team supporting us through the various aspects of our business. Now, looking at the portfolio, we've built a diversified and quite interesting portfolio over the last few years. Not all the companies here are EIS-able, but a large proportion are. And the breadth of our work covers telecoms, satcoms with SoftFund that also now has a defense aspect, deep tech recycling in the environmental plastic waste management space, name it, who are in lab technology, quality assurance, Vortex in liquid biopsy, Sage Tech Medical in anesthesiology, and also Green Aspect, Wanda Health, which is remote patient monitoring, Ventiv in heat pumps, Qbot in robotics, and so on and so forth. And it's quite a nice portfolio. We tend to take a deeper stake in these businesses. We get to know the management teams, and we support them not only with money, but also with management services where they need help in the episodes that they need help. As a result, we have a fairly low failure rate on this core portfolio. There was, very much related to the lemons and watermelons metaphor. I guess the way we look at things is, look, companies go through these different phases. Often you find that the first market they're targeting in doesn't quite work out. So you have to pivot, you have to change the investment thesis. That is stressful to the companies. Often it leads to changes in the management team, and we're there to support these companies. And as a result, we have this relatively low failure rate, but also consistent growth in value for a number of these companies. Now, in May last year, we took over the fund management of Hardman Capital, which is, some of you might know, is one of the well-known early-stage VCs in Cambridge, and also focus more broadly. We had actually co-led the spin-out of Martlet from Marshall Aerospace, and last year, the shareholders asked us to take over as fund manager. And that, for us, for our EIS practice, this is very exciting, because in addition to the companies that I showed you, this provides us with a solid deal flow pipeline of really interesting companies backed by other Cambridge and international investors in different stages of development. We are on the inside in a compliant way. We get access to pro rata rights and also get to know the teams and the co-investors. And we're very excited for our EIS practice that does from now onwards, we'll be able to co-invest. Our EIS fund will be able to co-invest alongside Martlet in these businesses. You've got here some of the leading names in deep tech and life sciences in the UK right now in the early stage. Paragraph is a world leader in graphene semiconductors. Oxford Space Systems is a leader in SATCOMs. Beam is very relevant in today's environment. They are a world leader in underwater drones that can not only support offshore wind, but can do other underwater kind of applications. Dogtooth are automating the picking of strawberries, which we all care very much about, especially in spring. On the life sciences side, Pencil Biosciences are developing novel gene editing tools, and so on and so forth. So it's really interesting companies, have been due diligenced over many years. Some of these also have a play around the AI space, companies like New Quantum, Porotech, providing the picks and shovels of the AI economy in terms of creating more effective compute or more energy efficient compute. So quite an exciting opportunity set that we'll be working with in the future. In the limited time I've got, I'll do a quick deep dive in of 3 of our companies. So Sofant is a Edinburgh University spin out. We were one of the early investors in it when the valuation was single digits. The valuation now is more kind of in the close to 40 mil. And they have developed what we believe is one of the world leading platforms for SATCOMs antennas for low and medium orbit satellites, which is now very relevant in UAVs, aircraft, building resilient telecoms infrastructures. We have stood by this company over many investment rounds. We're starting to see the results now. They have a purchase order from Viasat. They work with the European Space Agency, and so on and so forth. Wonder Health is another company that's gone through our venture build program, originally based on University of California IP. We worked with the company to make them more of a UK company and EIS-able. And after several years of them working kind of below the radar, they're now starting to break into the US market on the RPM space. They recently signed some really interesting contracts with the US, leading to an increase in their SaaS element. But again, the way we work with these companies is we work on a lean, capital light approach in building up these technology companies. There's many other digital health companies that have blown through 20, 30, 40 million pounds of money. With Wonder, we've been quite efficient in terms of how we got here. The last one I'll mention here is deep tech recycling. The IP originally comes from Warwick University and Birmingham University quite some time ago. We knew the originating company quite well. It got into trouble. They were close to a major IPO and didn't work out. So we ended up acquiring the assets from the administrators for a very low amount. And then we restarted the business again through our value creation services side with the team behind it on a very capital efficient model, working on SPVs with customers in the plastic packaging space. And now the company has 2 live projects that they're building up and the significant value inflection points. Working in a really big space, our estimates for the chemical recycling plant market are upwards of 100 billion in capex over the next decade. So to sum all of this up, it's not a classic VC fund. Basically, we've borrowed some of the tools from the PE space that can help you have lower failure rates and add value to these companies. We've borrowed what we believe works from the early stage VC space, and we've created something we think is quite unique. So we focused on these innovative deep tech companies that have strong IP. We look at also strengthening and mining the IP for licensing opportunities, for instance. We're looking at technologies that are developed, so it may well be that they're not quite in high revenues, but we can see how they'll get to the first pilot with a corporate and go beyond. And with that, we work closely with the companies to rebuild their financial model, and then rebuild it again as needed. So we spend a lot of time getting into the detail. Okay, how are we going to grow? Yes, your technology works. How are you going to sell this thing? How are you going to make money out of it? This value add, looking at point 4, again, helps us also see problems well ahead of time. So, it's a high risk space. We all know that, but we believe, look, if we see the problem, we deal with it early. And that often involves using people from my team to get into the company. We can't do it for all companies, but we do it for a number of those. And last but not least is the ESG drivers. So we don't advertise ourselves as an ESG company. We are focused on deep tech and life sciences companies, and we want to make them profitable, and we want to make a profit for our investors. However, as it happens, most of the interesting things in these spaces have a strong ESG element, whether it's around circular economy, around energy, around improved patient outcomes. So certainly that is also part of our consideration. So I'll stop at that and turn over for questions. As I flagged, if you want more detail on the EIS fund practice, you can contact my colleague Nick Salisbury. He's the head of capital raising, of course, myself. And thank you for listening.
Thanks for that, Ilian. Really good to know. Question come in on the sectors have changed dramatically over time, certainly in 30 years I've been in finance. What exactly does deep tech mean, just to kind of cover it? Because it's a kind of catch-all, but what exactly does that cover?
Yeah, it's an excellent question. I'm tempted to bring my head of research in here for the next 1 hour. But look, the way we see deep tech is it's IP intensive, science intensive companies. That doesn't exclude software. But if we are looking at software, it's going to be, how can I say, the clever bits of software. So we don't look at the SaaS business, but if there's an AI component combined with a hardware component, that's quite interesting. I would say that it's dangerous in our space to lock in too closely the sector. So the way we look at it is partly because we're close to the Cambridge cluster and a few other university clusters, we get to see new technology clusters emerge. So if you look at quantum computing, just 5 years ago it was pie in the sky stuff. It's like, yeah, nice. Maybe you read it in a Arthur C. Clarke novel and some good science fiction stuff. And it is now becoming real. So it's having this early radar, if you will, early visibility on new technology paradigms emerging and how they relate to real life, all the megatrends we're seeing, to real life problems. That is a skill set we've developed over many years. It also involves with early view on the IP. So I've gone a bit beyond, but I guess my main point here is whether it's deep tech or life sciences, the clusters of activity change, and they change every few years. So being early there and understanding how it's developing, the right point to invest, that's quite important.
Thank you for that answer. Another question, and it kind of overlaps a little bit with the last question, but can you talk about the pros and cons of investing in hardware relative to software?
I mean, there's the saying hardware is hard, which is true. But there's several things to look at. Most of this investment in the last decade has gone into SaaS and digital sort of projects. And some of them are pretty sophisticated stuff, and especially in the fintech and other areas. Our specialism is around hardware. That's what we've been doing for a long time. And our USP here is that over the many years we've been involved, we've built a number of playbooks that can help us decost and make capital efficient the development of hardware. I'll also say that developing a software business is not cheap by any terms. You might get to the first sale quicker in a software business, bunch of guys over the weekend, a couple of cases of Red Bull, and you've got a prototype on the Monday. Can't do that in hardware, can't do it in drug development. But to build a proper software business takes a lot of money. Your barriers to entry are lower, so actually it's more expensive, we believe, in a way, to build a successful mega software business. One good thing in the hardware space is that you do actually have more than one chance to get it right. The IP gives you high barriers to entry. So if you develop the technology platform for one application, doesn't quite work out, or it doesn't work out in a big enough way, you can pivot it to another application. You still have the IP aspect. And the final bit I'll mention is that the emergence of or the growth in AI tools is making hardware development faster, more efficient, more intelligent. So what we are seeing is that yes, hardware is still expensive, but it is much cheaper compared to 10 years ago. It's much cheaper compared to 5 years ago. So the teams we work with, we make sure that they have access to the latest tools in this space so that we can accelerate their development and stress test it and so on.
Perfect. I'll hand back to Brian. I think that's there's no more questions there.
Excellent. So having talked about introduced a couple of people that I've known for a long time, I'm introducing a firm that's still relatively new to me. So River Capital is a firm whose name is really pretty new because it's a rebranding, but I think, as I'll maybe talk about, they've got a substantial pedigree. We've got a double act. So we've got Dr. Mark Dabadie and David Walters. So I'm going to hand over to them.
Thank you, Brian. And good afternoon, everyone. My name is Mark Dabadie, and I'm the head of venture at River Capital. I'm joined by my colleague, David Walters, who's the investment director on Fund AI. And I'm going to tell you a little bit about River and what we do, and then I'll hand over to David, who can tell you a little bit more about the fund itself. First of all, just to say, this is a regulated product and all the usual disclaimers apply. So River Capital is a manager that manages multiple funds. We're based in the northwest of England, and we're part of a group that was established in 1994. So we've been around for 30 years. We manage about 100 million quid, and we've got a variety of investors, which includes pension funds, money from banks, money from the British Business Bank, balance sheet money, and also from high net worth individuals. Since inception, we've deployed over 200 million quid across equity and also debt products. And in doing that, we've supported over 2,000 businesses and leveraged over 350 million quid alongside that. Just to give you a bit of a sense of scale, the team now is over 20 FTEs. And if you include various fractional resources, there's probably something like about 30 heads or so. And here are a few of those heads. In the interest of time, I'm not going to go through all of them. I'll just highlight a few. One is our chairman, John Walker, who was a founding partner at Equistone, and before that, he was 20 years at Barclays Private Equity. My colleague Martin Sutton, he was employee number 4 at PKI, which is one of the success stories of artificial intelligence in the UK and in the North in particular. My colleague Steve Charnock, who's the chair of our investment committee, he is the founder of both Senkos and Seneca, and is an entrepreneur and investor in his own right. And last, but definitely not least, David Walters, who you'll hear from in a second, who's a member of the Data IQ 100. He's got substantial operational experience running various AI practices. He was the first digital and data director at Northwich Capital, whose job it was to take the data from the portfolio companies to drive value. And he has a series of exits under his belt as well. I'd just like to linger a little bit on those exits. So Fund AI itself is a relatively young fund, but River, as I say, has been around for 30 years in various guises. And we have multiple exits under our belt. And I'd just like to take you through a few of them. So one of them is a company called Blue Prism, which was a robotics process automation company, which we invested in 2006, which ultimately floated on AIM and reached that fabled unicorn status of being worth more than $1 billion. It was actually worth more than £1 billion at its peak. We've also exited VitaFlow, which is a clinical nutrition provider, which we sold to Nestlé in 2010. SEIS, one which is particularly close to my heart, which was stents for strokes, which was acquired by Stryker and delivered a return of up to 15 times the capital invested. And then just another 3. Tiger was a management buyout that delivered an IRR of just under 40%. That was middleware for the hospitality market. Centriforce, which we sold last year, which was recycled plastics in the utility, agricultural and landscaping sectors. That was 8 times return on money, 30% IRR. And then perhaps most pleasingly, Carebeans, which we invested in before Fund AI was launched, but which would have met essentially all of the criteria for it to be in Fund AI. It delivered a 3 times return. It was a whole period of just under 3 years and a 60% IRR. That was software for the sort of care sector. And that was delivered by David, who I'm going to hand over to in a second. Just to put a little bit of color on that last one, this is the Carebeans team at their exit dinner. Well, after we sold the company, you can see there Nick, Jeremy, and Ashwin in high spirits. We actually introduced Ashwin as the chair, as he'd been a chair in one of our other companies. And with that, I'm going to hand over to my colleague, David.
Good afternoon, everybody. As if by magic, Mark's turned into David. I'm Dave Walters. I'm the investment director at River Capital Fund AI. Fund AI is the North's first dedicated artificial intelligence fund, an EIS fund. We launched it in November 22, just before the explosion of generative AI. The reason why we launched Fund AI was because in other funds, we were constantly seeing businesses that had a lot of data, which wished to go on these AI journeys. As Mark says, I've run AI practices. I've exited large data businesses, and we are a unique blend of operators and also fund managers. So I think AI is probably the most significant global emerging technology, and in the UK we're good at it. We as a country are probably 3rd in the world in terms of the amount of AI businesses and the investment that goes into this space, behind the USA and China. And central government are supporting artificial intelligence investment all the time. But AI is not new. If you were to believe the press, it kind of launched in 2023 with ChatGPT and OpenAI. But we've been working in AI for decades collectively, and it's not just Gen AI, it's not just generative AI, it's not just ChatGPT. It includes robotics, natural language processing, computer vision. We are most interested in businesses that have got lots of data. That's where our superpowers are. We believe that businesses and management teams that recognize the value of lots and lots of data can build out deep IP and consequently create significant multiple arbitrage. There's a phenomenon called AI washing right now. So every company on the planet seems to be an AI company. What we bring to our investment diligence is a real expertise around what does good AI look like and what does slapping in a bit of Gen AI look like. We don't do the latter. We're looking to invest in companies that have got some really interesting technology. A little bit about the fund. Again, we were the North's first dedicated AI fund. Let me just move my screen a little bit. We target investment rounds of up to £2 million. All of our investments are alongside co-investors, many of whom you will recognise. We don't wish to underfund the company. Our target minimum return for a portfolio is 4 times. Whenever I'm diligencing a company, I'm looking to see a path to 10 times, but we talk about a 4 times overall return for an investment portfolio. We haven't yet invested in a pre-revenue company. We see a lot of AI companies coming through our CRM, and so far everything has been revenue generating. So I kind of expect a minimum company turnover of 250,000. Our most recent 2 are turning over £2 million and growing fast. For our investors, we look to create a portfolio of 8, target of 8, 6 to 8. And we look to deploy that cash within 12 months of investment. Minimum check size 10K for an investor, up to about 250K is typical. So why the North? Long story short, we think the valuations are lower up here. Around about 60% of all technology and specifically AI investment is focused down into the southeast and Cambridge. There is a ton of great AI companies up north, and we have this strap line that we are investing in underfished waters in the north. So we made investments in Edinburgh, we made investments in Cardiff. Our sweet spot's probably around the northwest and West Yorkshire, and everything to each side of that geography. Our first investment was the summer of 23. We made 7 investments so far. They are we're not particularly specific in anything. What I would say is we're not investing in the next OpenAI, which, is incredibly interesting from a technology perspective, but perhaps has a very slow return for investors. We're looking for businesses that are trying to solve real life problems, and those businesses have a lot of data. They're perhaps employing data science teams, they're using machine learning, they're creating their own algorithms, they're being really smart around generative AI and combining their own data sets. We have 2 soft closes. We do that deliberately so that if an investor wishes to invest into fund AI, we give them immediate portfolios, and therefore very quick EIS 3 certificates. And here are 3 examples. Mojo CX, we completed in January this year. The business is turning over £2 million. It creates artificial intelligence contact center software. It's got some great clients like Asda, Morrison's, Costa Coffee, already turning over £2 million revenue. We're co-investing alongside Procura and Foresight, and they've just won a new deal for £1 million a year from a large BPO. And it's a great valuation. And if you wish to find out more, I can tell you more about that. But these northern valuations are important. Another business called Hyperfinity hasn't quite hit the wires yet, but it's a Leeds-based decision intelligence platform. Once again, with some great clients, again turning over £2 million, a good valuation. Again, I can tell you what that is should you be interested, and won another £1 million contract with Salco. And then finally, back in November, we completed on a agritech business called Photenics, still open for investment. It's a Manchester University spin-out. It's in revenue. It's well funded. We have brought a co-investor alongside us to make sure that the business has got plenty of firepower to go on its journeys. And all of these companies, we provide artificial intelligence support, networks, ecosystems, advice, etc. So these 3 businesses close in March, at the end of March, and should anybody be interested to find out more, please get hold of us quickly. And then finally, the only picture with Claudia Winkleman on, I suspect. We won the GrowthInvest 2023 New Product of the Year award, which we're very proud of. And this year we were also finalists in the Growth Investor Awards for the up-and-coming EIS fund. Thank you very much.
Great, thank you for that, Mark and David. And I do hope that last picture wasn't AI generated with Claudia there. Question: as a fellow northerner, I fully appreciate the focus on North. Is it exclusive? If you found the right valuation for a not northern-based company, would you look at them too?
Yeah, I mean, we reserve 20% for outside of the regions, because you're absolutely right. If somebody comes to us and say, tell us about a company that we're super interested in, we want to be able to give ourselves the capacity to invest outside of the region. But valuations are really important, Steve. Typically when we see those opportunities, they're just too high for us. We want to be able to, as I say, try and get to that sort of path to 10 times. And if the business is valuing itself at £20 million, we've got to sell it for 200 million. So, but yeah, we have a 20% capacity.
Cool, good to know. You mentioned as well, obviously AI is not new, it's been around for a long time, but it feels like it's fairly new. It's a very fast moving environment. What challenges does that bring to both yourselves as a manager and to the companies?
I think, I'll give you an example. DeepSeek is a Chinese-based large language model, which is doing something called reasoning. It's been out for 3 months, and it's already being used on the Chinese stock exchange to help traders to make the right decisions. That you can see how that could be a double-edged sword. Some businesses may feel that they can start to integrate those sorts of large language models into their workflows. We've got lots of businesses across our portfolio who are using LLMs really well, and they've got some good stories and they've got some bad stories. And that's one of the things that we hope that we can bring to all of our investments. We've now got a cohort of businesses all thinking about the same sorts of problems and how to adopt them and when to adopt them.
Lastly, DeepSeek, has that made a big impact on valuations? Has it been a game changer or just a noise in the long road?
Well, without getting too technical, one of the things that DeepSeek are doing really well is how to use the hardware underneath a large language model. So there are 3 things that create artificial intelligence. One is maths, one is data, and one is processing power. The Metas, the Googles, the OpenAIs of this world are spending a ton of cash, hundreds of millions of pounds on that processing power bit. DeepSeek have found a way to do that at an absolute fraction of the price. Their latest LLM's only been out for 3 months, so nobody wants to be a guinea pig yet to actually work out how to use that properly. But it could be transformational in terms of the way that artificial intelligence becomes even more democratized for businesses.
Great, thanks very much. I'm going to hand you back to Brian.
Thank you very much to Mark and David. Always good to hear about what the hot areas are doing and how they're actually nothing new under the sun is also as well. I'm going to move on now to another relatively new EIS fund, but one that has actually created a strong impression in the market already. So I'd like to welcome Marcus Love from Love Ventures.
Thank you, Brian. Okay, so I know we've only got 10 minutes, so we're going to keep this fairly fast-paced. We've got a lot to get through. So yes, I'm Marcus Love, General Partner at Love Ventures. Before we get started, there is the usual disclaimer that this is a very illiquid and high-risk asset class, and you should seek your own tax advice. So who are Love Ventures? Well, we back exceptional founders that are reimagining how and where we spend our time and money. As I said, I'm general partner. I founded the business with my brother, Adrian. My background is I spent nearly 10 years in Paris working in technology with large firms like Capgemini. I moved back to London in 2005. I spent 14 years in the city selling independent equity research to fund managers. And during that period, I trained my brain to look at large mega trends, all in the listed space, listed stocks. But I started angel investing in 2015 with my brother. And we built up a pretty nice portfolio and a strong track record. We backed around 20 companies. We backed Revolut, where we've just taken out some money at a 400x. The valuation was 45 billion. The portfolio is actually at 7.65 of what we put in, so TVPI in the jargon, and a 48% IRR. And what we decided to do was build Love Ventures and try and replicate that and build a super stellar team around us. So in the investment team is myself and my brother. His background is in property. We have Alice and Bill, who joined us from Backed VC and Barclays Ventures, respectively. And we are basically, the way we pitch ourselves as a VC in an EIS wrapper. We think and breathe VC. So if I look at the investment committee we have 2 people in the US and 3 in the UK. So Jules Pancholi was a founding board member at Skyscanner. He saw that journey all the way up to an exit to Seedtrip for 1.4 billion. They had Sir Mike Moritz on the board, who's probably the best venture capitalist the British Isles has ever produced when he was at Sequoia. Kelly DeCourty was brought to Silicon Valley by Meg Whitman when she was at Hewlett Packard. She subsequently went to Google, where she was SVP of their go-to-market operations and strategy in the cloud. She subsequently joined UiPath, which is a Romanian-based poster child for European VC, listed on the NASDAQ, and she left there last summer. She's starting a new role shortly. John Lunn was a serial entrepreneur. Then he went to PayPal, where he was a 4th employee in Europe, saw huge growth in PayPal. He's a renowned fintech and payments expert globally. He's currently on his next startup called Gravy, which is cloud orchestrations, payments in the cloud. Dan Cobley was Google MD in the UK and Ireland. He left that to start ClearScore and Salary Finance, which you may be familiar with. He's a very prolific angel investor here in the UK and joined our investment committee last summer. And then finally, Rob Hamilton set up the Instant Group, which was basically flexible workspace before WeWork. We got two senior advisors at the bottom. I won't go into them more for the leadership team. And the striking thing here is that while only 8% of European VCs have actually worked in a startup or a scale up, nearly all of our team have. And 3 of those 5 investment committee members are exited. And as you see in the little bubble on the right, they help add value to the companies. When we back them, we do strategy sessions, we sit down with them to work out how we can get them from seed to Series A, which is primarily where we specialize. We look at large keys themes and trends. We've heard today about adoption of AI, but actually we like untapping productivity. We want to untap the UK's productivity. We've been at a stable and not very exciting growth level since 2008, the global financial crisis. We're lagging the US by about 16%. But actually, I think, like others have said, we think we do have the talent right here. We hosted an event in our offices last night with Hussein Kasai, who exited on Fido and has now started a new AI business. I went to the launch of the London AI Tech Hub, which he did a few weeks ago. It's just fantastic turnout and some really exciting businesses all started here in the UK. We want to invest with purpose. So companies like Temba, we're going to talk about that, solving for the housing crisis and getting people onto the ladder for the first time. And actually, we often invest at the intersection of these areas. Moving on to our core sectors of expertise, we have fintech, future of work, and consumer tech. We don't have time to go into big detail on these, but suffice to say that fintech with the UK as a superpower in this sector. We've always been very strong in it in Love Ventures, obviously with the likes of companies like Revolut that we've backed, but about 40% of our portfolio to date has been in fintech. The future of work is how we are becoming more capital efficient with the use of software for companies, but also for individuals. I think we're all using lots of amazing tools to make ourselves more efficient. And we talk a lot about what we call the 10x human, which sounds like sci-fi, but it's not. It's just making us better and better and more productive. And then consumer tech, around 40% of the UK's unicorns come from the consumer-facing sector. We're very good at it as well. And we want to back world-beating UK-based EIS-eligible companies that grow and scale globally. To give a few examples of companies in our portfolio, we're not going to be able to do enough today. We've got 27 to date. I'm going to bring to life just a couple. So one is Tembo. I think some of the participants on the call may be familiar with, because it's a digital mortgage broker. They've just done their Series B with a very big US investor called Goodwater, who backed Monzo at Series C. We invested very early when it was just a handful of employees. They've now just reached 100 employees. They did £6.5 million of revenue in 2024. They've now got a cash savings product, which has 250 million AUA. They're going to try and grow that to 2 billion this year. The most exciting bullet point is the last one, actually. After 4 years of existence, this is the 5th fastest growing consumer fintech in the UK at that revenue level. So having backed the likes of Revolut, we see very strong similarities with this sort of company, which are growing very fast, executing very, very well, strongly backed by other really good VCs. We see here that you've got Aviva Ventures that put money into the last round as well, and on a real strong path to grow the business meaningfully and then to exit. The second one I wanted to spotlight is Fifth Dimension. So Fifth Dimension is a AI co-worker for property professionals. It's like having an assistant in your email that when you do, say, a planning application for a mid-sized building, you need about 15,000 documents. Ellie, the co-worker, will say to you, I can see you're doing a planning application, let me assist you. And from that moment forth, you've got someone really to help speed up the process and cut time, making you more efficient. We invested in October 23 in a round led by CCAM, which is the UK-based preeminent VC firm. And in the last round, led by Speed Invest, which is a European VC, we were the only EIS fund in that round. And that's why I said at the beginning, we are a VC and an EIS wrapper. You are going to get access to top investments through EIS eligible vehicles that we operate into rounds that no other VCs are getting into that have the EIS moniker, because we work really hard to get into these rounds through our advisors with our reputation and the value added we can bring. On the right-hand side, just one of those bullet points, the the revenue that this company is doing with lots of companies like Knight Frank and Wolf Group, etc., we've made about 40% of those introductions, commercial introductions to that company. And that's really where we add a lot of value, is bringing in our network and obviously the ability to follow on with capital as well. Our due diligence process, just to highlight here, these are annualized 24 figures. So we saw around 2,000 companies last year. We took 29 through to advise and made 23 to IC and made 12 investments. So we do make around one a month. We made a 13th investment outside of the EIS fund, which was our co-investment Series B investment into Timber. So that's, I think, probably fairly standard for a lot of the other participants on this call, but it's a very, very thorough process. We have to meet with the advisors that are down the bottom left-hand side of the screen. Everything is thoroughly screened as they go through and validated by our tax consultant, who is Philip Hare, and by our lawyer to make sure we get the EIS eligibility for all of our downstream investors. Investing with Love Ventures today, just a brief highlight of who, the top level numbers. We have 20 million pounds of investment today, all started from scratch. As Brian said, we are new kids on the block, but we've actually been around 5 years this summer. We are FCA regulated as of last July. We are a serious bona fide outfit. So we're challenging existing. I think today's webinar was under new approaches to EIS. So we see ourselves very much in a slightly sleepy world. We want to shake it up. We want to provide the VC feeling to investors of what they get with us. We're investing on a 7-year horizon in the EIS fund. The minimum investment is £25,000. There's a 3% upfront fee that gets reduced for subsequent investors that come back and invest with us again. There's a 2% per annum management fee over 4 years. In the future, we're hoping to bring that down as our AUM increases, and we're targeting a 3.17x return. So for a £25,000 investment, we're hoping to return just over £75,000, all exempt from capital gains tax for EIS eligible investors. Crucially, the bottom right-hand bullet point, we really want to bring investors on the journey with us. So as I said, we hosted an event last night. We had 100 people here. It was absolutely thriving. It was a fantastic event. We also do deployment updates monthly when we deploy the capital, and biannual reports with a bit more in-depth behind the scenes views on each of these companies. And we're targeting 12 companies, as I said, during the April to April tax year. So any investors coming in now will be deployed from April 25 to April 26. If you've liked what you've seen today, then on the bottom right, there's a sign-up QR code to join a webinar next Wednesday with one of the investment companies that we're going to be backing after this April close. So Chris Milligan is a previously exited founder. He's now into his next business. He's backed by Experian, and what he's building is employee verification. He's at £1.3 million of annualized revenues. He's a fantastic founder. So do please join us, and open to the floor for questions. Thank you.
Hi, Marcus. Thank you for that. Question for you. Obviously, as Brian mentioned and you mentioned as well, you're relatively new, 5 years old as the fund, looking for a kind of 7-year holding period. Where do you see exits coming from? I guess this is one thing that investors and advisors are really looking for. Where do you see them coming from? And obviously IPO listings is one of those routes. How do you see the markets, the UK markets particularly, for the ability to go public for these companies?
Yeah, thank you. I'm glad you asked that question. We're working on an exit right now. It's actually a future investor that wants to invest in the business, and we're looking at a up to 3x return, having held the company for 3 years and 1 month. So we're outside the 3 exemption period, and the IRR will be 32%. So it doesn't have to be an IPO. Obviously, IPO is the holy grail for the likes of Revolut that we backed, but within our fund, we have opportunities for a lot of these companies for larger trade exits. The environment in the UK is much better. There's a recycling of capital going on. There are secondaries going on, as we call them, so they don't have to be IPOs. And the market is perking up. So we've seen that opportunity. We see several portfolio companies. We've got 2 actually potential secondaries as we're speaking right now. But there's one that we're going to pursue, one where we're going to keep the company for longer, as we believe it could be a fund returner.
Great, thanks. And then secondly, you mentioned there about one of the founders you've invested in. I think it's still on the screen there now. How important do you think it is the founder, and particularly founders with experience of existing businesses?
Yeah, it's really important. We just got a very short slide deck. Actually, one of our slides is about what we look for. So founder market fit, as we call it, is one of them. So deep domain expertise, preferably a founder who's done something before, like Chris has. It doesn't have to be a success. A failure is fine too, because they learn from that. Chris happens to have had a successful exit, so he really knows what he's doing and has deep domain expertise in where we invested. There are other criteria as well, which are important: large total addressable market, a scalable model, good unit economics for the business, depth of cap table, make sure there's other good investors in there, and obviously a path to sensible exit for our investors.
Thank you very much, Marcus. Very good to see that you've got an exit coming in. I think the market has been struggling a bit for exit over the last sort of 2-3 years. As I mentioned, there's been a downturn. So the fact that you're going to get ones, I think sort of we've seen 1 or 2 others recently. So hopefully that is a sign of an upturn in the market for that. So congratulations.
Thank you.
Last but certainly by no means least, I'd like to introduce Mark Beaumont from EOS Advisory. Mark has probably the most interesting CV of anybody in this market, as the background to suggests. But he's not going to talk very much about that. He's going to focus very much on EOS. So with no further hesitation, I'd like to introduce Mark Beaumont.
Thanks very much, Brian. And thanks everyone for staying to the end of this webinar till the end. I was just looking down the guests who are online right now, and I'm delighted to see some of our investors, some of our previous innovation fund EIS investors. So thank you for coming along to hear more about what we're doing, and indeed some other really credible players across the UK market. So if I start to share my screen, I can give a brief introduction to who we are. So EOS is a Scottish-based investment group founded in St Andrews 10 years ago. And for the first 6-7 years of that time, it was an angel investment group. I was one of the angels, one of the 80. And around 2021, started to talk about, should we scale our operations, build out our executive capacity to support these companies beyond seed stage, and the ability to keep a seat at the table and invest at growth rounds as well as seed stage. So launched our first innovation fund right at the end of 2021, started deploying that across 2022. So the scale up of our operations, both by our executive capacity, but also our capital to support these companies, has scaled up significantly since January 2022. So in that sense, we're sort of 10 going on 11 years old, but the last 3 years has seen the majority of that activity by capital. And in terms of my team, there's 14 of us, 12 in Scotland and 2 over in the US. And if you ever come along to one of our showcase events, the big 2 themes that you'll hear us talking about is, how do we add value beyond writing a check? How do you complement these sort of incomplete technology-focused companies when we meet them and make them market-focused? And the second big theme is internationalization. How do you get these companies thinking about international global markets as early as possible, which explains some of our team outside of the UK. So a very brief introduction to myself. As Brian mentioned, I spent the first 15 years of my career as a professional athlete and broadcaster. I've written 6 books. I spent the first decade of my career working for the BBC, doing big expedition documentaries. So the big theme at the start was very much about people and performance. And there's 3 operating partners within EOS. One, Andrew McNeil, who's a venture-backed scientist who scaled a couple of very successful medical device companies, so knew what it was like to be on the other side of the table. Andrew Durkee, who spent 30 years in corporate finance and clearly leads on our transactions, and myself, with this very different background, but a track record for building record-breaking teams and breaking world records. So it's a really interesting group of people who have come together to say, how do we take the very best knowledge-intensive science and technology and help these companies move faster into global markets? So I've already mentioned some of the team. You might well recognize some of the logos of our amazing portfolio companies. About 60% of the portfolio is in healthcare, and about 40% of the portfolio is in environmental sustainability. So clear focus on people and planet. And I'm speaking to you from Edinburgh today. We do invest across the UK. Our portfolio is UK-wide. We are still biased to Scotland and homegrown talent, partly because this is where we've got the deepest network and connections and deal flow. But also, and this came up with some of the other presentations, there one of the biggest advantages of operating in the north and in Scotland is price. Valuations are lower, and wage bills are considerably lower. And if you think your biggest cost in early stage companies, especially pre-revenue, is your wage bill, we have considerable success taking these companies from Scotland into the EU and Scotland into the US. And when you bring in really credible co-investors from those territories, they cannot believe the progress you can make in companies for often £2-3 million, as opposed to what they would look at in, say, California or other geographies. So that you can start to see the business model. Try and find university spin-outs predominantly, with really strong IP portfolios, backable management teams, which are by definition incomplete. And then we really wrap our arms around them in a venture building model. The way I always talk about it is planting about 600 acorns a year. We look at the market of 400 or 500 opportunities and really wrap our arms around the best 5 to 8. It normally averages out to about 6. And that's what the Innovation Fund is. The Innovation Fund, our EIS vehicle, cornerstones that seed stage activity. And it allows us to invest 8 to 10 million at seed stage in this really carefully selected portfolio. And then we have a network of what we call venture partners who are interested in growth stage companies that come out of the work from the Innovation Fund. So clearly not all companies track at the same speed and different capital journeys. So because we're working incredibly closely, especially in those first 2-3 years, we will bring to our group of venture partners the best performing companies out of that. And the Innovation Fund can participate in the first couple of rounds. So most of our network in our EIS fund, our Innovation Fund, are individuals, so family offices and firms. And so actually, even though it is an EIS fund, over half of those involved are not actually doing so for the tax benefits. They're doing so because of the business opportunities, the investment opportunities, the fundamentals, which I take as a real compliment. A good number of our investors are overseas or investing outside of individuals. All the partners at EOS invest ourselves through the fund. We're quite excited about the companies we're involved in, but it is worth noting that it's a slightly unusual makeup of investors who look for long-term partnerships into these types of businesses. So a couple of examples of the companies we're working with. As mentioned, a real focus on quality of life and environmental sustainability. And there's pretty clear reasons why we would focus on these areas. If you're backing research-rich companies, IP-rich companies that are addressing global markets, then that potential can be massive, but actually to bridge that gap is significantly difficult if you don't have the capital to do that, and also the expertise to help these often academic founders look up and look out and bridge the potential with the market. And if you think about the big market trends over the next 25 years, we believe that this is some of the biggest venture opportunities around. I described before the areas we work in, for our first investments often in the 1 to 5 million range. But the really important part of our scale up is the ability to keep a seat at the table as these companies grow up. So I promised to finish with some live examples, companies we're working with at the moment. Before I mentioned the one on the screen, the last big Series A that we led was actually outside of Scotland. It was a Bath University spin-out called Nature Beads, which has a technology that replaces microbead plastics, so addressing plastic pollution. It's also a healthcare issue where people ingest microbead plastics because it's in all sorts of everyday materials like sun creams and lipsticks and others. And there's EU legislation coming in by 2030 to ban the use of microbead plastics. So we particularly like technologies like this where there's market conditions to mandate the change. You're not just investing in something that looks exciting and makes sense in and of itself, but there's actually market conditions that mandate that change in behavior. We led a 7.8 million Series A recently. We're building a factory out in Italy. But the really important part of that story with Nature Beads is the ability for us to bring in 4.5 million of that 7.8, and more importantly, to bring in a network of international co-investors. So Italian, Singaporean, and Austrian investors, de-risking and really adding something to these business growth stories that we couldn't. We can build the bridges out, but we need people in other global territories to scale these companies into different global markets. And that's the business model. And the last comment on NatureBeads is we had an exit in December 2023, a company called NatureBeads, where we exited to a group of Dutch investors. And the best thing we did there, apart from returning 12 times money to our investors, was to bring the chairman, who had overseen that scaling and manufacturing and growth into the EU, straight into NatureBeads to oversee exactly the same process. So you're bringing the skill set back in to help a company do that hugely challenging part, to go from a demonstration model into full commercial scale and sales. So for us, it's about plugging in the exec, the non-exec experience, and trying to build that playbook for international growth with these types of companies. So I'll just finish with a couple of comments on some deals in progress. All three of these on the screen have grown out of our innovation fund over the last 3 years. BioLiberty is an amazing medical device company which helps people who've had strokes or neurodegenerative conditions. It's a spin out from Edinburgh University, and we've already supported that company get its FDA approval for sales in the US, and have a really credible US investor coming in at their Series A shortly. So a couple of the team have already moved over to the US, and if you leave a company like that to its own devices, it might well be scaling into a local NHS market, but doing what we've done with our Californian connections, you can see that a company like BioLiberty is on a completely different trajectory. Green Bioactives, from the environmental sustainability side of the portfolio, takes plant stem cells and creates them in a lab environment. So you've got a very predictable source of ingredients for all sorts of manufacturing. It's an amazing technology, again, spun out of Edinburgh University, where we've managed to bring in a network of co-investors to scale, and they're now in market, gross revenue from the innovation fund work. And last but not least, Lavrock Therapeutics, backing David Venables and his team. David Venables has had 3 successful exits in the past. 2 went public and 1 was a trade sale. And Lavrock, is being a biotech, is one of those companies in a diversified portfolio that you want it to be a sort of a 1 in 10. It's higher risk, it's longer to market, but it's the biggest market opportunity when you get it right. And co-investing with the likes of Eli Lilly and Calculus Capital, incredibly credible group of investors to back a company who are trying to address solid cancer tumor states, which is the real holy grail within cancer treatment at the moment. So I hope that's an interesting introduction to what we do at EOS. You can see this whole idea of deep roots in the local science community that we're a part of, but from day one thinking globally about how we help these companies scale out. So I'll pause there and hand back, and thank you for staying on this webinar till the very end.
That's great. Thanks for that, Mark. One question, because I'm very conscious we're very running tight to the 2 p.m. cutoff. You yourself and a few of the managers have mentioned university spin-outs as a source for the investee companies. Now, academics aren't always the most commercial people. How do you support academics to be more commercial?
Yeah, it's the reason that a lot of investors don't invest in the university space without naming any names. It's that exact risk of commercializing people who haven't worked in the business world before. We see the flip side of that, which is, for everyone that says that that's difficult, we see a massive opportunity with some of the most exciting, scalable, venture-backable companies in the ecosystem, because they're not companies that are thought up in a pub on a Friday night. They're companies that come out of years and years of research. But you've got to accept that often the founding team are often best skilled to keep doing the technology and the operations, as opposed to that sort of CEO leadership role long term. So if you look at our portfolio, there's a huge amount of complementing that founding team, bringing in the right skill sets, and also fundamentally thinking, where are you taking these companies? Because they're technology companies as opposed to just tech companies like apps or platforms, you're normally scaling them to a global trade sale. And you've got to have a view on where that's likely to be from as early as possible. And these academic founders almost never have that skill set. So that comment I made about bringing in the right governance and reporting board experience from day one really helps that. And it's why we really see the hard work in these companies in the first 6 months to turn our due diligence process into a value creation plan, first 100 days and beyond. And you can start to see the sporting analogies. For me, it's all about that sort of sprint mindset. How do you get the right people working on the right parts of the plan, and understanding that these companies are by definition incomplete when we meet them.
Thank you very much, and thank you very much, Mark, for finishing us off on a good note. I'd like to thank everybody very much for coming along. I'd particularly want to thank James, Ilian, Mark and David, Marcus and Mark. If you want to contact any managers, you can find them all on Google, or you can contact us. We will put you in touch directly. We'd be happy to do that. Thank you very much to everybody for attending and staying to the end. And we look forward to seeing you hopefully on another webinar soon. Thank you very much.